Hello, everyone, and welcome to December's ACECRT Financial Wellness Webinar Series, where we'll be discussing budgeting. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on your webinar menu. And at the end, we will take some time to go through these. Now I'd like to introduce our guest speaker, Pension Mark, Deanna Bamford. Mrs. Bamford joined the Pension Mark team in 1992 after graduating from the University of California at Santa Barbara with a Bachelor of Arts degree in Communications. Mrs. Bamford is the Relationship Manager for Pension Mark's Northern California clientele and provides bilingual enrollment support to many of Pension Mark's clients. Mrs. Bamford has obtained the Certified Employee Benefit Specialist certification, and she is also fluent in Spanish. And with that, I'll turn it over to you, Deanna.
Thank you, Tori, and good afternoon, everyone. And once again, I want to thank you for taking the time out of this busy season of the year to focus on an important piece of attaining your retirement and overall goals, and that is focusing on a budget. So today's seminar, we're going to take a look at the advantages of budgeting, why you should create and stick to a budget if you're not doing it already, and today we'll discuss some basic strategies that will get you on the road to successful budgeting. And keep in mind that this is some good general education, and I'm going to hopefully give you some nice tips and tools that you can use in budgeting, but I'm not able to give you any true legal or tax advice. So for those more in-depth topics, you'll want to defer to and refer to attorneys and accountants. So we'll get started here, and intermingled here throughout the presentation, we have some polling questions because as always, we like your feedback and your input. So first, let's start off with what is a budget? And basically, it's just a way to crunch numbers to help ensure that the money you spend doesn't exceed the money you earn. But it's more than that. It's not, just creating this budget. It's really a plan, and it's a plan for trying to save more money to fund things like your retirement plan and other short-term and long-term goals, and help you spend wisely what you do make. You may know approximately how much you spend each month, but you might be surprised to find out that you're overlooking some expenses. So just knowing where and how you spend your money is the first step in creating this budget or plan. And budgeting is more than simply just saying what portion of your money should go to which expense. It's more than that, just putting things in categories. It's a way for you to help increase your financial predictability, just to have a better, clear understanding of how much you earn and where you're spending that money. And with that understanding, hopefully, this helps you to better prepare and be ready for those inevitable surprises, financial emergencies that come up, just by being able to identify your income and expenses. So that when, the water heater breaks and the car breaks down and your dentist refers your child to the orthodontist and you're in for some large payments coming up, you're not, you might be surprised initially, but you'll be prepared. It can also, creating this plan and knowing can improve your standing with lenders. And, just having this budget in place can potentially help your overall credit score and make you a more desirable candidate for a lender. So lots of good can come out of this. So next, let's take a look at the first step, step one in budgeting, and that's going to be to evaluate all your income. There may be more income to your picture than just your weekly or biweekly or monthly paycheck. Perhaps you earn money from periodic self-employment or a weekend job. You may also be earning interest from bank accounts or dividends from other investments. Perhaps you're receiving some monthly alimony or child support payments. This should all be part of your equation. You need to be aware of all these to create a solid and accurate foundation for budgeting. If you're unsure or just, can't recall, a good place to probably start is to look back, pull out a copy of your income tax filing from the prior year, and look at the various income sources listed there. Then you're sure not to forget any. So next we have our first polling question. And today I'd just like to know of our audience here listening in, how many of you know the difference between a variable and a fixed expense? So number one, yes, if you understand the difference, and no, perhaps if you're not sure. I'll give you a few moments and we'll take a look at the results. I've got a wise and intelligent group here. So 90% of you said that yes, you understand the difference between a variable and a fixed expense, but we do have 10% that maybe is unsure. And that's important. So let's talk about those differences and the next step here in creating a budget. So your next step, you need to quantify your expenses. So a good way to analyze your expenses is to break them into these two categories, fixed versus variable. So here we go. For the 10% of us that weren't sure, your fixed expenses are those that are relatively predictable month to month. So some examples are going to be your taxes, your home payment, whether it be rent or you're paying on a mortgage, utilities and insurance premiums, car payments. Those are all examples of fixed expenses that tend to be consistent month to month. And often those are the ones that are difficult to trim or to cut out, as opposed to your variable expenses. So what a variable expense can change at any given time, actually. Some examples are going to be the cost of food and fuel or gas, clothing, entertainment, medical. These are all expenses that kind of come and go, ebb and flow. Even something like food, I think you could predict, but if you're like me, this time of year, my grocery bill is gone up exponentially because of gatherings and entertaining family and friends, which I like to do this time of year, but it certainly does stretch my budget. So those are things those are in your variable category. And so by doing this, you can really start to see what you can cut back on and what you can't. So next, after you've established your expenses, then you should try to track your expenses for at least 2 months. You need probably a good, solid couple months worth of this tracking to know where your money is really going. Now, although you don't have much control over your income, how much is coming in, you certainly can control your spending. That's one area you have the power to change. And the best way to start cutting back on expenses is to know where you're spending. That's obviously a first step. So we recommend that you maintain a detailed spending log of all your activity. And this can be done, simple save receipts on everything you spend, and then you can just kind of add them up at the end of the month and do this for a couple of months. There's also, online tools that I'm going to briefly talk about here later in the presentation that you can use to help you track those expenses. And by doing so, you may be surprised how much you're spending and where you're spending your money. And again, you may find some areas that you can trim expenses without too much difficulty once you kind of track them and see where it's going. So next we have another polling question. Here we go. Our second question is, which type of goals does your current budget reflect? So as you think about your budget, are you considering your short-term, intermediate, your long-term goals, or perhaps number 4 would be a combination of all? So if you could please just take a moment and indicate which goals your current budget reflects. We got a bit of a split here on the results of this question. So 27% of you said your budget reflects your short-term goals, and I think that's pretty common. We've got to get through the month to month. But an equal amount, 27%, intermediate-term goals. So you're looking out a few years and trying to plan for that. 0% said long-term goals, and that's good. You don't want to focus solely on long-term goals, but we had 45% indicate that it's a combination of all, which is excellent. That's really what it should be, and that's what we're going to talk about next here is prioritizing and categorizing your goals. So on the next slide here, you've probably already started thinking about your expenses as we're talking about this and what you should cut. One effective way to do it is to put them into categories and prioritize each item. Which expenses are unavoidable? Which are luxuries? And the luxuries are almost always easier to do without. Obviously, the unavoidable ones often we cannot cut. So we got to take a look at these luxuries, such as eating out and going to movies, the theater, and always wanting to be the first to get the latest and greatest technology that comes out. Some of these are luxuries, and perhaps you can trim some of those short-term expenses to help fund and get to your long-term goals. So sometimes, just prioritizing them and categorizing them into their duration is what can help you create this budget and help you, again, as we said before, you may not be able to control your income, but you can control your spending. So you can really try to determine, do you need that daily latte, that daily cup of coffee? Can you get away with maybe just once a week, a Friday morning, brew some coffee at home? Perhaps there's other expenses that you find that you can completely do without, maybe that aren't healthy or recommended for you. And so the goal is not to completely strip away every comfort, every luxury. That's not the point whatsoever. You work hard for your money, and you should certainly be able to incorporate some of those luxuries into your budget. But what this prioritizing can help us do is just make better decisions and know where your money is going and fit in those little luxuries that are important and do without the ones that are not. So next, it's now time to do some math. We need to compare, once you've now listed out your income and your expenses, we need to compare your consolidated income to your consolidated expenses. Do you have a surplus or do you have a deficit? The fact is that a conscientious management of your personal finance requires a budget, regardless of whether you have a deficit or a surplus. If you're really going to try to attain both short-term and long-term goals, you need to have a set, firm understanding of what's coming in and what's going out. If you find yourself in a position where expenses are higher than income, you've got to look at, again, those variable expenses to find areas to trim. Because these expenses are typically non-essential, it should be easy to shave a couple of dollars here or there to help you come closer to your income. You would like these, the income and the expenses to match, more closely align. And again, this can be a simple pencil to paper calculation, or we're going to look at some tools here in a moment that can help do this for you. So next, if you're like most people, you don't have a single goal in mind. You have several that you're considering. Some are in the near future and some further down the road. So as you clarify your financial goals, determine whether you want to reach them within a year or 5 years or even further, this will help you in planning and saving, right? And how much, not only how far out in the future are these goals, but how much will each cost you? So, and also you need to keep in mind that those intermediate and long-term goals should take into account inflation and interest rates. If you're saving to purchase a home or for education costs for family, children, we got to take into account if it's 10 years out the price, today's price, is going to increase. So again, fortunately, most of the calculators and tools that we provide online automatically take into account an inflation rate of, most of them estimate about 3%. And then you can also usually put into those calculations an estimated interest that you'll be earning, and there's ways to assist you in determining that based on past performance. So just important, again, to kind of know when these goals are and how much they're going to cost to better be able to plan for them. So next, once you've kind of set your short-term and intermediate and long-term goals, it's time to prioritize them. This is where you take a closer look at how your income compares to your goal, near-term and long-term. Which goals are going to require the most money? When will you need that money? Are your goals equally important? So, where does that kitchen remodeling rank? Is that so important? And it's going to be different for each person, right? Everybody has different goals, and what's important to you is different, but the only way to achieve those goals is to make sure that your goals are in sync with your current income, and to prioritize them and to start saving towards them. Again, it's going to vary person to person. So next, I'm going to show you just some small steps you can take to help increase the amount you save each month. Again, these are just little things that you can do that may help you, because many spending habits are so ingrained that we don't even know we're spending. So again, once you've done the exercise of listing them all out, here are some just little tips to help trim down those costs. Pack a lunch. That can save tens of, $20, $30, $40 a week by just brown bagging it. Other ways is, skip the beverages at restaurants. That can get really expensive when everybody orders something other than water. You can see an afternoon movie instead of an evening. That could be $3 to $5 savings right there. And then some of the bigger things you can do, the bigger picture you really need to look at, is if you're paying any debt, get those paid off and prioritize them. Any higher interest rates you're paying, you want to pay those first. And definitely try not to just pay those minimum credit card payments. That will certainly extend your debt requirement. So these are just little ways that you can do things to help save. And your last resort is to cut back on your savings, your personal savings. Don't skimp on saving for yourself and those long-term goals. So do all that you can before that. Make adjustments that you can make. Stick to them as needed. Keep track, again, of all that you spend. And another little tip, too, with those credit cards and interest rates, they're typically not going to be reaching out to you and saying, hey, did you know we can offer you a lower rate? But you'd be surprised if you take the time and call the creditor and simply ask, just say, is there a better interest rate that I can get? Because, I'm being offered, I'm sure everybody gets those advertisements in the mail every day to consolidate debt for lower rates, and you'd be surprised. They'll want to keep your business and perhaps lower those interest rates for you. So just a few tips here. And next we've got our third polling question. Do you currently use some type of financial tool to monitor your budget? So I'm just curious here, out of our audience, are you using a tool to help keep track? Yes or no? Let's see what our audience came up with here. We got a nice 50-50 split. So half of you, yes, are actively using a tool, and half of you, no. Well, good news. We're going to look at some tools that are available to you, and hopefully that'll help. I think that's a primary step, and there's some good tools available. So thank you for your responses there. So here we go. Here is a tool that is available to you through the ACEC RT Wellness Center, and this is what we call the Personal Financial Portal, and this is available to every one of you at no additional cost just because you're part of the ACEC RT Wellness Program Retirement Plan. This is a all-inclusive online tool where you can access all your financial accounts in one place. We have done webinars on this before. We have them recorded, and they should be on your Financial Wellness Center, Education Center. So please refer back to those if you want some more detailed information. But basically, this tool gives you the ability to track all your spending habits, access reporting, monitor your accounts. And what it does is once you have connected it to your financial institutions where all your money is, again, it's just an easier way rather than having to save all those receipts. It knows where you spent your money, records it, and you can have it automatically. After a few months, it'll start establishing a budget for you, and then you can go in and customize it and make changes. Also in this tool, there's ways to predict those long-term goals like retirement. So we have a great gap analysis tool that's embedded here in this program so that you can see, are you on track for your goal? And it gives you some tips and ways to save more or to reach that goal. So again, here is one tool that's available to you, again, at no cost. You just reach out to the Wellness Center, which at the end here of the seminar, we're going to put up the contact information if you don't know the number or email or website address on how to get this information. But I hope that you take advantage and utilize this tool. So our final question today is, what do you believe to be a reasonable expenditure for holiday gifts? Number one, do you think 1.5% of your annual income is reasonable? Or number two, 3% of your annual income? Or number three, 2% of your annual income? We'll give you a moment here, and since we're talking about budgeting and we're in the season here, I thought it'd be interesting to see what you thought would be reasonable. And what's going to be even a better exercise for you afterwards, hopefully you can compare this to your true budget and see where you fall according to your decision. And there's no right or wrong answer, of course. It's just, does this fit into your budget? So we've got the results coming up here. Ooh, interesting, good. So we've got about 80% of you that say the 1.5% of annual income, that's reasonable to spend on holiday gifts. And 0% to 3%, good for you, that might be a bit high. And 20% indicated number three, that 2% of annual income seems reasonable. So again, just an exercise. These are some of the things that often are overlooked, are not budgeted for, and suddenly we come to the year end and you're almost surprised, or even though you know it's coming, if you haven't properly budgeted or prepared, this is where you fall into debt and using that, and it kind of perpetuates the problem. So thank you for honestly responding to that. And then finally here, now that we've discussed budgeting and goals, and hopefully once you take the time to establish your own budget and goals, then you don't forget to review this budget. And we recommend that you take a look at least monthly. And again, if you're using that PFP, Personal Financial Portal, it's so easy and accessible, you could do it even more often than monthly. But if you're just writing it on paper and saving receipts and charting it out, monthly is probably sufficient. But you need to, on an ongoing basis, it's important to review your budget, make sure you're still on track. Every couple of months, you need to take another look through the budget and compare your actual expenses to what you've created on the budget. And this evaluation should show you where to make changes so you can better stay on track. So the real work starts now. It's up to you. I hope you have found this information somewhat helpful, a few tips and tools that you can use. And as we start off, end 2015 and look into 2016, I just wish you the best and hope that you're able to reach those goals that you've set, and hopefully this budgeting advice will help you get there. Now, thank you so much, and I'll turn it back over to Tori.
Thank you, Deanna. We appreciate you sharing your time and knowledge with everyone here today. And as Deanna mentioned, you are more than welcome to reach out to the Financial Wellness Health Center with any questions that you might have from this webinar, or if there's anything else that you have questions about, anything plan specific or investment related, you can contact the Financial Wellness Health Center by phone or by email, and that contact information is up there on the screen for you. So this will conclude our webinar session. Thank you again, Deanna, and thank you, attendees, for your participation. I hope everyone has a beautiful holiday, and we look forward to our next webinar series with you. Take care.